おはようございまして。
Oh, good evening. Can you hear me?
I see you very well.
Mhm.
Can you see me?
Yes, I can. As for starters, could you please summarize why investing in stock has become a loser's game? I would also like to know the reasons why it is reasonable to invest in indexes to win the loser's game.
Well, there's three kinds of difficulty.
Mm-hmm.
First question is,
mm-hmm.
It's always hard to save.
Mm-hmm.
The second question is,
mm-hmm.
It's not very hard to invest for the long term,
mm-hmm.
because companies build more and more profitability, and therefore, you know that in a long term,
mm-hmm.
your investments will rise and get larger and more valuable.
Mm-hmm.
The problem that many people get into
mm-hmm.
is trying to do better than accepting the market
mm-hmm.
price
mm-hmm.
and trying to figure out which stocks they should be buying and selling and buying and selling and selling and buying.
Mm-hmm.
And that is exceptionally difficult
mm-hmm.
because the other people who are investors are also trying very hard to do
mm-hmm.
the best that they could do.
Mm-hmm. Mm-hmm.
And the cost of having an active manager
mm-hmm.
and the operating costs of being an active manager
mm-hmm.
combined make for a very high hurdle
mm-hmm.
that in today's market is very difficult to overcome.
Mm-hmm. Mm-hmm.
That's why roughly 85% of active managers fall
mm-hmm.
short
mm-hmm.
after fees and after operating costs,
mm-hmm.
but that's before taxes,
mm-hmm.
than the market itself.
Mm-hmm.
And that's why indexing has gotten to be so increasingly popular.
So in that sense, there are so many professionals. So it is impossible for anyone to be the long-term winner, consecutive winner.
Well, let me say it a little bit more carefully.
Mm-hmm.
It is very difficult, and I'll come to an exception if you want to, very difficult to do better than the market rate of return over
mm-hmm.
the long run.
Oh, okay.
Now, I can give you an exception.
Mm-hmm.
Would you like the exception?
Oh, okay.
Okay.
Mm-hmm.
If you had a group of very good analysts,
mm-hmm.
and they were working on companies that nobody else was paying much attention to, much
mm-hmm.
smaller companies, and they really understood their industry, I believe
mm-hmm.
that such an organization can, over the long term,
mm-hmm.
achieve better than market rates of return.
Mm-hmm.
But it's very hard to find them.
Mm-hmm.
And if they are very good, they usually
mm-hmm.
get flooded with so much money they can't keep doing what they used to do.
As one of the biggest reasons why investing in stocks has become loser's game, I assume you may mention efficient market hypothesis.
Well, as you know from looking at the book,
mm-hmm.
There are several different factors that are happening.
Mm-hmm.
First is the number of people who are involved in active investment management has gone from about 5,000 50 years ago
mm-hmm.
to at least 500,000
mm-hmm.
and probably 1 million people
mm-hmm.
all over the world.
Mm-hmm.
The second thing is there's been a Darwinian process of sorting out the very best managers.
mm-hmm.
So only the very best managers are still involved in active
mm-hmm.
investing.
Mm-hmm.
And that means that, yes, it's easy to find a very good manager, but can you find a very good manager who is better than the other very good managers? That's what's really hard.
Mm-hmm.
Governments have required more and more companies to provide more and more information on a fair basis to everybody.
Mm-hmm.
So the result is that there's an enormous amount of information is available,
mm-hmm.
but it's available to everybody else at exactly the same time. That was not the case 50 years ago.
Right now, the market is that efficient by the fact that many professionals are competing against each other. So that many people catch every information at the same time. So that market has become that efficient. Still, the market is going down and going up that often. So it seems to me that sometimes the market is very insane. So why the market is that kind of situation very often?
That's a wonderful question. The difference might be the right place to start is it used 50 years ago, there was a real difference in how much people knew and how accurate that information was and how quickly they got it. That's all been canceled out. But it's still true that people are estimating not only what's going to happen in the future, but how the people who are competing with them will react today to what they might think is going to happen in the future. So you're watching a group of very, very smart people all trying to anticipate each other as to what is going to be the way in which they will evaluate the information. If you stood back and looked at not a day's trading or a month's trading or a year trading, but 25 years, you would say, oh, it doesn't change all that much. It's a sort of a pretty much a straight line, except for this one period when there was a lot of concern about COVID. So there are driving forces of opinion that move markets at least as much as the driving forces of fact. And the facts are always behind us and the opinions are out in front of us. So each of us will have different opinions. Then I have to have an opinion about your opinion and you have to have opinions about my opinion. And that makes it also part of the volatility.
So stock market, not only in the US, but also in other countries have already recovered, and the major indexes of US stocks have even renewed all-time highs frequently since a huge decline due to pandemic. Well, what is your impression of these dramatic recoveries? What can individual investors learn from these recoveries?
Well, one is that if you go back to when we were all very deeply concerned about the trouble, to recognize that when we are deeply concerned about trouble, or excited by positive things, they don't last. The world keeps coming back to its normal way of behaving, pretty much the way, same way. Just as you may have days when you feel just terrific, and you may have days when you're sick and you're feeling terrible, but you will be you all the time, and you will come back to being the same very interesting man 5 years from now, 5 days from now, 5 weeks from now. You won't change who you are normally. And the markets have a normal rate, and then they have fluctuations around that normal rate of gain. And the fluctuations are driven by people's emotions, and the long-term trend is driven by the facts of company earnings and interest rates. Interest rates, of course, do make a big difference. And one of the things that's been driving markets in the last couple of years is that the central banks of the world have been pushing interest rates down to very, very low levels.
Early last year, we saw huge surges of prices of stocks, of GameStop and AMD and so on. Could you tell me your perception of this phenomenon called GameStop frenzy? What can investors learn from this frenzy?
Well, we will learn in what years from now, looking back. I'm pretty sure that most people studying the situation today will say those stocks got separated from the professional market, and the prices got driven by a group of enthusiastic, usually young people, often with no particular experience, who were just playing against the prices rather than against the values. And most professionals would say that's very, very dangerous.
So do you think major indexes of US stocks will rise as much as they did in the past 3 years? We already saw a 27% surge last year as of S&P 500. Will we see that kind of surge this year?
I would be very, very, very surprised if that were to happen. The future is not going to be changed by what stock prices have done in the last 2 or 3 years. or what stock prices will do in the next 2 or 3 years. The future is going to be the same. And I believe personally that prices are quite high, and therefore the returns have been wonderful for those who are invested. But I do not think that the future returns will be anything like what we've seen in the past. Last few years have been a world record.
You mentioned in the latest version of your book, Winning the Loser's Game, that investors should reconsider investment in bonds because with the interest rates very low or even below zero, we cannot get as much returns as we did decades ago. What should we invest in instead of bonds?
Well, for long-term investing from here, the returns won't be as great as they have been in the past, but they'll be better in stocks than they will be in bonds. As the interest rates rise, bonds are going to have price pressure down. And even though stock prices are high, they will go higher over the long-term future, 5 years, 10 years, 20 years from now. And most people don't realize how much they already have in what is stable assets or comparable to fixed income. People who invest in securities very often have a home of their own, and the value of that home is part of their total financial portfolio. Then in many countries, they have retirement incomes that are assured to them by their company or by the nation. And that's got a real value today, even though you're not yet retired. And that's a pretty stable value. It does not go up and down with the stock market. And then many people have future earnings and savings ahead of them, particularly young people. And that's not going to be changed by how the stock market does. It's going to be changed by how they do in their work and in their careers. So if you look at all those other parts of the total financial picture or total financial portfolio, the securities portion is pretty small, and most of the non-securities assets are very stable relative to stock prices going up and down. So I believe most people make a mistake when they look only at their securities portfolio to make a major decision about their total financial picture.
Large portion of indexes are occupied. So maybe 25% of those indexes are just GAFAM and Tesla, those giants. So some people may think that it is inappropriate. Those indexes are, large portion of those indexes are occupied by those giants. So in that sense, some people think, indexes S&P 500 are not the average of the market because a large portion of that index is occupied by just 5 companies.
Right. Let me try to answer it in a way that may not be complete for what you have in mind, sir. I believe very strongly that almost everybody, and certainly all normal people who have not spent all their lives working in the investment world, those of us who are anywhere near that should invest in equities in index funds. Now, having said that, did you know that there are more indexes than there are stocks listed on the New York Stock Exchange? There are indexes of all sorts. And the S&P 500 is a very popular, highly regarded, very carefully done index. But there's a total world market index. There's a British stock market index. There's a Japanese stock market index. There are technology indexes. There are ESG indexes. There are all kinds of indexes. And so you have to choose which one would work best for you. The normal answer to your question would be, if you don't really have a strong opinion about what you want to be doing for the long term, then you should be investing in a total world index that has investments in every major country around the world.
Mhm.
in proportion to the value of those companies in the marketplace. And I believe that makes a great deal of sense. If you then say, yes, but I have a strong reason to believe deeply that something different from that would be a good idea, there's an index that will match whatever you think you're looking for. But I would recommend people start with the most conservative decision. Perfectly okay to do the S&P 500. Although I think most people would say today, yes, but it's got a couple of stocks that have been bid up to very high prices. Maybe they won't stay up that high. And maybe a small cap index would be a better idea. Somebody else would say, well, no, I think a European index would be a better idea. My own personal view is unless you have a very strong opinion that you're willing to stay with for at least 10 years, that you should invest in a total world index fund. And then concentrate on low cost when you do that.
So why is it necessary for investors to stay in stock market all the time and avoid timing markets?
Well, there's a long history of people trying to figure out which way the market is going to go. And the long history says, so far, almost nobody has been able to do it. And if you found somebody who had been able to do it for the last 20 years, I can promise you he or she will not be able to do it over the next 20 years. It just doesn't work. And so we should recognize it doesn't work and therefore invest with that understanding.
In your book, you mentioned that large portion of returns of stock came from just limited days in the past 10 years or 20 years. So I think that is one of the reasons why investors should stay at market all the time in order to avoid, how can I put it, prevent from not being there at the market when you can get that return by from limited days.
Yes, and that's one of the reasons that market timing doesn't work. Because if you look at the causal factors underneath, you'd say, well, when did people try market timing? Usually when there's more negative information and everybody's anxious and worried, and the market has been going down and people say to each other, it's been going down, I think it's going to keep going down. Look at the terrible things that are going to happen in the future. That, of course, is why the stock market is down, is because people are looking at negative things in the future. So you decide, now I'm not going to stay in this investment. I'm going to stop and raise cash. It's that low base that like a coiled spring gets stronger and stronger and stronger. And someday the opinion of the world starts to change. And they say, well, maybe it'll be tough, but it won't be as bad as it was. Maybe COVID won't be as serious a problem as we thought it was going to be. And that spring will then open up and the market prices will go back towards the trend line or even above the trend line. There's a sense of relief, but the normal trend line is in there, but you've gone way down under because of fear and anxiety. And then all of a sudden it goes up. And when it goes up very, very quickly. And the same thing is true the other way around. Oh my golly, we're not going to have everything working out beautifully. And all we have to do is own tech stocks and we'll fly to the moon and everything will be exciting. And somebody starts to say, well, you know, I'm not absolutely sure you'll fly to the moon. In fact, I think you might not even get off the ground. And then all of a sudden back towards the long-term trend. Trying to figure out which day, which week, which month is the right time to get out. Boy, is that tough because we're all trying to anticipate what others are doing and others are anticipating what we're doing. And then we're trying to anticipate their anticipations of our anticipations of their anticipations. It's like being in a hall of mirrors. It's one after another after another. And so the right and simple answer is don't get excited positively or negatively by current activities. Stay in for the long run and you'll do very, very well.